Now, fixed capital investment, $2 million. The project has got the 6-year life. So we're going to have 6 years of the life of the project. So basically what I'm going to do now, let me just squeeze this one. Okay, that's what I don't need it. I need this one only. Now, and then on the other side, I'll put 6 years, okay, like this. I'll get back to it again. So moving down, the initial investment in net working capital is 200,000. At the end of each year, this is the keywords that you need to pay attention. The net working capital must be increased, adjusted, so that the cumulative investment in net working capital is 1/6 of the next year's projected sales. So that's the point you need to carefully estimate the net working capital. So initial year, the net working capital is 200,000. But if you remember from the quiz, there was no any initial net working capital. There was only like every single year for the corresponding sales revenue should have got the percentage, the part of it. And it says that net working capital every year gonna be changing here. So I will put here the net for year 1, 2, 3, 4, 5 will be changing. It will be, as said, it will be increased as next year projected sales. Okay, it will be 1/6 of the next year projected sales. So we need to calculate the sales on the other side. So 1/6 means here I will just calculate 1/6. 1/6 is 1.16, which we're going to be using the next year sales. I'll come to that point again. Now, and it has got some depreciation value. Fixed capital is depreciated 30% in year 1, 35% in year 2, 20% in year 3, and 10% in year 4, 5, and so on. And in total, the depreciation is 100%. So I'll put the values here as, let me, so sales, OPEX, if there's some OPEX will be, I don't know, I haven't checked it yet. Maybe, I think there's a variable cost, yeah. Variable cost, fixed cost, and depreciation. Okay, I'll put that. Now, depreciation, it says 30% in year 1, 35% in year 2, and so on. So I need to get these values for each year, but our fixed capital investment is 2 million. So means that 35% in year 1. So 35% multiplied by CapEx, the capital investment. Sorry? It's 35%. I get it from here. Like, it's 30%, yeah? Yeah, it's a 30% here. It's a 30% in year 1. So I have to correct it. So I'll correct it. Basically, this is 30%. Then 30% in year, again, 35% in year 2. And 20% in year 3. Again, CapEx. And 10% in year 4. The 1 cell represents the CapEx, capital investment. And in year 5, it's 5%. And in year 0, it's a 0%, so nothing. Okay, that's what I have it, actually. Okay. Now, that's what depreciation estimation is. Now I need to go for sales. So let me wait for you to finish with the depreciation. Just give me a hint and notion that you have finalized it. Okay. Done? Okay, perfect. Now, let's go with the sales. It says that sales are 1,200,000 in year 1. So 1,200,000 in year 1. And it's gonna grow by 25% annual rate for the next 2 years. Like second and third year, it will grow by 25%. And the third and fourth, for the last 3 years, it will grow by 10%. So, no, 4, 5, 6. 4, 5, 6. So 1.25 multiplied by this. And next year is this. Okay. And the fourth and the fifth year, it's going to grow by 10%. This multiplied by 1.1. Okay, here we go. Okay, that's the sales. Like first 2 years. Because it says here, look, 25% it grows annual rate for the next 2 years after the sale 1. Once we put the year 1, 1,200,000, these 2 years, it will grow by 25% each year annually. And then last 3 years, like this last 3 years, it will grow by 10% annually. That's what the question means here. Okay? Is that clear? Yes, please. It's just 1.1. Not for both years, for each year separately. So the previous year will be growing by 1.1. That's what it means. Okay, now we go for the fixed cost. It's 150,000 for the first 3 years. Okay. And 130 for the last 3 years. That's what the fixed cost. There's no logic. Just get the number and plug it into the cells. That's it. And variable costs are here. It's 40% of the sales of the year one. So in year one, it will be 40%. In year two, it's going to be 39% of the sales. And in year three, which is 39%, that will be applicable for the last 3 years. And Jania can confirm it. And we don't change the number, we just pull it to the right. For the last 4 years, it will be 38% of the sales. That's what our model looks like before getting the EBIT. Okay. And the marginal tax rate is 30%. I'll put, sorry?
3 years, 38%.
38 for the last 4 years, starting from year 3. Starting from year 3 and ends at year 6. And the marginal tax rate is 30%. And what else I have here? Okay, and it says that the Lawton will sell its fixed capital investment for 150,000 when the project terminates and recapture its cumulative investment net working capital. So all those net working capital that will be calculated now, right after it, the liquidation value of the fixed capital investment will be 150,000. So, or salvage value is equal to 150,000. Lawton will, okay. Income tax will be paid on any gains, okay, if there is some taxes that need to be paid, if there is a gain. The project's required rate of return is 12%. So rate or discount rate is 12%. If taxable income on the project is negative in any year, the loss will offset the gains elsewhere in a corporation, resulting in a tax saving. So it tells you that if you get loss, and if there's a loss initially, you assume there is no kind of tax payment, but however, it will be offset as a tax saving. So that should go as a plus when you will be calculating the terminal value. Okay, sometimes when the book value is more than the salvage value, then it means that you don't make any gain here. You incur a loss. That means that you're not gonna be paying any income. That was the case of the quiz that we had it. There was a book value remaining 29,000, which was much higher than, or was it the higher? I don't remember the question. So no, it was the lower because from the quiz. The salvage value was 50,000 and the book value was remaining balance as 29,000, which I will underline it soon. Okay. Now, Are you all with me? Hope we are all on the same page. Okay. Okay. Now, determine that whether that project is profitable investment using the NPV and IRR, and that if tax rate is to increases to 40%, so on. So now we need to calculate. Okay, now I'm just closing this page. I don't need it. I will work on this. Okay. First, I need to calculate the net working capitals for each year. In each year, we have it like, which is 200,000, which has been mentioned in the question. Now I need to move to for corresponding year. It says that it's a cumulatively adjusted, cumulatively increased of the next projected sales. Means that it's 1/6 that we have calculated. So for this year, for the first year, if you're going to be calculating net working capital, it's basically 0.16 multiply the next year's sales that we have estimated. Okay. And it should be adjusted to the previous net working capital, which is minus 200,000. That's what you get at 50,000. Did you all get the same? Okay. Then this year, the second year net working capital is 1/6 of the next projected sales, and it should be adjusted cumulatively too. Cumulative adjustment means you should subtract the previous net working capitals, like in plural form, okay? Not just one, but all what is remaining behind. Now we are in year second, means that in the previous years, we have two different net working capitals remaining, 50,000 and 200,000. These two things should be subtracted when you calculate the year two. So 0.16 multiplied by this year and minus this minus 200,000. The word cumulative, it's a kind of a keyword that you use it. Adjustment. Yes, please. The quiz was the same. The quiz that we had it was exactly the same. No differences. Sometimes when it doesn't kind of specifically say that the cumulative, still you have to go by default, subtracting the previous in order to calculate today's change. Okay? It's by default cumulative. Like if it tells you like every single year you have the net working capital.
So that would mean that each year they add net working capital.
Yeah. That's the shows that each year, for example, some firms, some companies, they just put it in everything in sales, like the whole amount, like in sales. In the sales, they have net working capital too that circulates in the economy, in the business. Now, for the purpose of calculating the terminal value, we need to take it out and to calculate. Now, okay, the same thing we're gonna have here. This multiplied the next year and minus previous 3 years. And here, this multiplied this. And the last one. Okay. On the 6th year, we don't have anything because we don't have any 7th year sales. So let me just double check. I might be mistaken somewhere. I might be making some Let me check the numbers. Yeah, they're correct. Correct. Sorry? In year 3, make sure that you subtracted all the numbers and make sure that you have multiplied by the next year's sales. Which year should I show it? The 3rd year. Okay.
The answer, it's, as for the answer, it's rounded numbers.
In the book, yeah, it's rounded. They just, and they remove the 3 decimal numbers. Okay. Now, let's go with EBIT, earnings before interest and tax. It's basically what? Sales minus variable cost minus fixed cost minus depreciation. That's what we have it. Okay. Let me check it.
That's right.
Yeah. Just to be sure. Yeah, I might be still. Tax amount is 30%. So this 30, I'm gonna fix it. Oops. Yeah, 30% of the EBIT. Again, guys, you might have thought that this is negative, then I should not write any taxes. But you should assume it's a tax saving. Okay, the government kind of reimburse it for you. When you make a loss this year and you don't pay any taxes, for the next year, the tax will reimburse it. This is how it works in the tax offices. Okay, because when you pay the taxes, you make some estimation how much you're gonna be paying. It doesn't mean that you're gonna be paying exactly the amount that you estimated. But when you go to the tax offices, you see the different number there. It can be over, it can be under your estimation. So if the government realizes that this year you made a loss, for the next year, they will do the reimbursement for you, where you will pay less tax than you're supposed to pay. It works in every country like this, actually, not only the Kazakhstan, not only the countries that I know. But the amount of the reimbursement changes, of course. It's not the amount that you make a loss, okay? There's some kind of subsidy comes. And you know, nowadays, if when it comes to taxes, there is a ESG taxes too. After your net income derived, you pay the ESG taxes in Europe. In here, it didn't come yet. But when it comes, maybe your tax, my friend has got the company, he says, construction company, he says, in total, I pay maybe 80% of the taxes from the all income I generate. He says, like my capital that circulates in a month, like net working capital, in total, it's like 2 million euro. And from all months, maybe 15 or 20,000 net income is left after paying all taxes.
It's like inevitable.
Yeah, he has to pay. If you don't pay, you're just out of the business. They will just squeeze you because there's a ESG, like social taxes, environmental taxes, governance taxes, profit taxes, and never ends. Yeah, for him, yeah, left 20,000 euro something after 2 million of sales he makes. And of course, it's better than still working for someone. Like if he works for someone, he receives 5,000 euro maximum. So why I'm saying you to just make you to compare how the businesses are running here and there. You will see the pressure is totally different. He had a business in Russia. He said that in Germany, he's working in Germany, in Berlin. He said it's much, much tougher the business to do in Germany than in Russia. Because there, the profit at least left like 50% what he earns generally. And the tax profit there is like more than 40%. We'll come to this ESG taxes later chapters, but not now. It will be here soon in Kazakhstan. It comes very soon. Because ESG became a very significant issue in any businesses. It cannot be ignored, and it's kind of it becomes part of the life, even in the universities. There will be a time when all the organizations, regardless of the business, they will have to comply with the ESG practices. There will be no choices given. As I know, like the World Bank stopped financing since this year the projects who are not compliant with the ESG practices. They said, we're not going to finance any single project which do not comply with the ESG. Okay, now let's calculate. Let me just double check what we have here. So taxes on operating income, and we have OCF after tax. This minus this. And what else? I have it here. I need to add the depreciation back because it is non-cash item. So I'm going to just put like add depreciation. So I'm going to move it here. Okay. It's given. I just link the cells with the previous cell. Like it was F8 and just put in F12. It's just a linkage. Let me just check it. Okay. Then I'm gonna put here terminal value of non-operational cash flow. Like it's non-operational because you're gonna sell your equipment or your investment. It comes from non-operational side. And we can see from here, we don't have any remaining book value. Like at the end of the 5th year, it becomes directly zero. So there's no problem with tax issue, okay? That's definitely shows that we're gonna be paying the taxes on our, there's a definite gain from the salvage value. So it shows that salvage value is 150,000 plus, here we go. Now, in here, we should add all the net working capital that we had in each single year. Previously, we were adding only the initial one that we made it in the year 0. Now we will add the initial one plus each corresponding year that we estimated. So plus 200,000 plus, I'll just put the word sum and add this net working capitals. Like this. Because it will be recovered back. We'll get this money from the business, okay? Or if it was inventory, we'll get it back. Okay? And minus, as we are making gain on sale, we have to pay the tax. And the tax is like 30% multiplied by salvage value. Yeah, here.
The book value totally depreciated.
Yeah, it's depreciated fully to 0. But in the quiz example that we had it has not been not been depreciated to 0. It still there were some remaining the book value. And guys, when you go home, please don't forget to review the replacement project too. Okay, we are now talking about the expansion. Imagine it's a cumulative networking and replacement too. So that makes a bit challenging question. So it's a kind of piango, okay, for the next class. You select the questions. The questions will be given randomly to you. You never know whether you to select the expansion or replacement. So you might be preparing for expansion, but you have replacement. Sorry? You never know. Simulation could be for replacement too. Like Monte Carlo analysis, this risk sensitivity analysis, not only for expansion case, for all cases. It can be for replacement, it can be for expansion. The main idea is to know how to construct the model for replacement and for expansion. One question, just one big question, which will have 10 questions inside.
Interrelated questions.
Yeah, of course, like it will be one like comprehensive big question. And you will have to bring one cheat sheet. I was thinking to let you to kind of go through the lecture notes. That's not a good idea because you will not study well. When you just take a note, that makes you to memorize more in detail to dive it more into the question. So write down, I suggest you to create a cheat sheet, put two sides, like replacement, this model looks like, and expansion looks like. So whenever replacement comes, use these formulas. Whenever expansion comes, use these formulas. No, cheat sheet, both sides. You can use both sides. One paper, but don't bring two cheat sheets. One cheat sheet, but both sides. I would accept only if it's handwritten. No acceptance will be given to the printed because you can put all the materials in one paper with a 6 size of.
Handwritten Excel.
Not Excel. No, guys, I want from you to just bring the formulas for you to guidance because you don't know what questions will come. And you will be prepared for the formulas. Like you should remember that to construct the model, there's 3 steps. The first step to calculate the investment cost. The second step to calculate the cash flows for each year. And the third step to calculate the terminal value. So 3 formulas. But these 3 formulas changes from replacement to expansion. Okay, you have to know this only. And then you construct. And just remember the order of this. That's very important. And here, yes, please.
Should we take the same places?
Should we take what?
The same places.
For the quiz.
Same places for the, yeah, you can, no, there's no problem. Unless you haven't put anything there. Some special notes. Okay. Let me just continue. Let me check it up. There was I think we're kind of, okay. We made a mistake somewhere. Look, the return of net, it's just,
No, it's okay.
it's okay because they haven't calculated the terminal value. They just directly include it in here. Okay. Now I will calculate. Guys, sometimes it's called total OCF, like total operational cash flow. Sometimes it's called free cash flows. So the way you want to you call it as you think that is better for you to memorize it. But never mind, like, now, this is investment cost. Like I'll start from here, from the year 1. So basically in year 1, what I will do, OCF after tax plus the depreciation that I just added back and minus net working capital for that year. Okay. If there is a net working capital, but if in the question there is no net working capital, you don't have to subtract anything. You just add these 2 things and that's it. And I just pull it to the right.
Why do you subtract net working capital?
It's a cost. It's a money that goes out of your pocket in that specific year. You put it into the business. No, you haven't. You have taken it here. It hasn't been counted. In terminal value, we are recovering it back. We are getting it back. Now we are in here, you're just taking out from your pocket. In terminal value, you're putting into your pocket. The money that you put into the business to circulate, you will get it back when you finalize your project. Okay. Okay, now that's what we have it for each year. And the last year, we will have to add the terminal value too. Okay. Any question? Quiz was easier than the midterm. No, guys, in the quiz, it was a bit challenging, 10 different questions. But in the midterm, you have only one question, and you know what questions you should expect, either replacement or expansion. Honestly speaking, the exam is not itself difficult. The only thing, if you study well, if you know how to differentiate the replacement from the expansion, it's easy. It is easy to get really good grade on that case. Okay. And don't try to be kind of scared, like it's going to be complicated, something like this. No worries, like it's going to be very simple, straightforward. You need to just understand, you need to put yourself into the shoes as if it is you're running the business, like you want to do the feasibility analysis for your own. Like there will be cases like you're buying land, you're buying this, and just explaining it. Just imagine you're doing your business. How are you going to evaluate your business? How are you going to evaluate your project? Yes, please. Sorry? Okay, which? This one. It's correct. Ah, to send it to you. Okay, I thought like, can you check it? Okay. Okay, I will definitely, when I finish, I will sell it to you. Send it to you. I just said sell it. I like this word to sell. I always sell. When the exam comes, it's the right time to sell. It's a complementary kind of product. Complementary for the final exam, for the midterm. Okay, now, so far we have computed all the cash flows. Now we need to compute investment cost. It's basically initial investment plus, yeah. But it should be negative. Okay. So this model is divided into three pieces. Okay. The first one is this. Second one, this cash flows that you calculate, that you need to go with. I will do it like this. And the third is this. So these three things you need to calculate. Just bring these formulas with you and use it. And you will not be kind of lost. But put everything into their own cells. Salvage value, net working capital, taxes, and so on. Believe me, you will not be, it will be very difficult to be lost in calculation. If you put everything in good order, now, let me move further. Yeah, correct. And I need to calculate the NPV. So NPV rate is 12%. Values are here. and investment cost is this one. Yes, please.
Some situation where we had working capital each year, we should always deduct it from the total production.
Again, at what, where?
When we have a situation where we add net working capital each year, so
Where you add it? In what case you're adding it? You don't add it everywhere. You add it on only in one case. When your business ends, when the project stops, and when you estimate the terminal value of non-operational cash flows, in that case, you add all net working capital for each year. You sum them up and bring it to the last year.
but also we need to
Subtract, yeah, you need to deduct from the total operational cash flow. The logic is that this money goes from your pocket. When you start the business, you spend in that year, in the specific year. Not spending, but you take the money and put it into the business to kind of for operational points, like for the day-to-day activities. Like you buy inventories. For example, I have a garden in myself, yeah. I paid some amount when to start some. I planted the raspberries. And additionally, 1 year later, I bought apples, okay, to plant it as well. So these apples are kind of inventories now in me. I didn't plant it yet then, but they're like I spent maybe 2-3 million tenge on that. They're still there. I can get this money back in any case to resell it by reselling this inventory. That's the example of net working capital I can give you. But they're still with you. I spend this money, but my apple now in the inventories, ready to be kind of planted for the next year. If I don't plant it, let's say I finalize my project, I will sell these apples for someone who wants to plant it, and I will get my money back. Like net working capital is basically current asset minus current liabilities. Increase in net working capital means what? You have more current asset than the current liabilities. What is your current asset? It's a cash, it's a account receivable, it's an inventory. Okay, that are currently run. For what you need these current assets? For daily, day-to-day activities, for day-to-day operation that you have been involved in. Yeah, that's the logic. Account receivable, still there, you will receive it. Cash is still there, circulates, you put into the business. You don't carry your cash of your business in your pocket. Or do you carry? I don't know, like in my case, my business is separate, my personal life is separate. You cannot mix them, otherwise you will not earn any money on that.
it could be also possibilities, right?
Yeah, anything like you just make investment, which is like why you need to. The logic of having the current asset is that to make your position liquid. In case you have a liquidity problem, you can easily sell it. Same with me. I bought these apples. I can even sell them now. I need like 2 million tenge now. I just call, okay, I have apples. Please buy it. There are many like clients who wants to buy it. Like it's the main idea that stands behind the current assets is to liquidate yourself, to make it more liquid.
Can we deduct net working capital from the
Total
operational cash flow
operational cash flow.
to divide the money that was earned by the business and the money that you
You,
just invested?
yeah, you put not reinvested, but you put into the business. It's not the investment. You put it for circulation, just to be on the safe side. We can say there could be a different reason, but in my case, it's a different reason. I want to I bought it now for next year. I could have waited for the next year, but I want it now. Just put it into the business. Okay. I don't know, let me check. Yeah, correct. So it's profitable. You can calculate IRR if there is a need. Okay. Any question?
Usual payment period.
Yeah.
Other. Первую учитывая, что
Please check the last year. Did you add the terminal value of the last year? Like 1,513. Check all the numbers one by one.
And we got this MPV and IRR and we make what conclusion about the situation? Yes,
No,
it's liquid.
No, not liquid. It's profitable. The question is here. Determine whether there is a profitable investment using NPV and IRR. Is it profitable? Yes. Yeah, it's feasible. So you can run the project. You accept the project. IRR even tells you the same thing because IRR is more than your discount rate. Okay. Yeah, in the book, definitely. It's there, here. It's here, right away here. It's here. It's an L drive. If you just follow here down, you have it. There are many examples that I told you last time. Please go with that. I think it's top above. Yes. Guys, last time I told you that please go with the book examples. And I got one question from here. Similar example. The quiz. Same thing, just go with the replacement on the slides in here. Expansion replacement. I don't want from you something else. Just know how to calculate expansion replacement. I cannot give you the numbers like this number is going to be the example. Only the just similarities that you can be having. This is the replacement. No, it's not a surprise question. It was just test of your background of your finance. No background. No. As I said, in the midterm, you have only one case where you have to work. Okay, now I will move to the quiz. Okay, we have like 15 minutes left. I'll have to do everything in 15 minutes. Let me save this file. How should I call it? Yes. Prep. For negative. Yeah, it could be. I don't know. This is what you have to decide. So the question is asking here, if IRR is more than discount rate, but the NPV is negative, is your project feasible? Because the last decision is made based on NPV, because you're caring about the equity value of your project rather than just the number. Okay, guys, let me just be quick. This is the question, yeah? Cash flow projection. Okay, let's go with that. So initial investment 500,000, expected salvage value 50,000 at the end of the year 5. Okay, expected sales revenue 300 in year 1, growing 5% per year. Cost of goods sold 40% of revenue. OpEx is 50,000 per year, increasing by 3%. Depreciation is using the max 5-year of class life below table. So we're going to be using this. Tax rate 25. Discount rate is 10%. Working capital requirement is 10% of revenue adjusted at the beginning of each year. But means by default it's cumulative. And the project will end in year 5. Okay. Let's do it. So I'll get this. So I don't have fixed cost and the variable cost, but I have cost of goods sold. And I have OpEx. And my sales, it said here. The sales is here, 300,000 in year 1, and it grows 5% annually. So 0, 1, 2, 3, 4, 5. So 300,000. And it grows by 5%. 105 by 300. That's what we have it. And OpEx, cost of goods sold, it has been said to be 40% of revenue. 40 of revenue. That's what we have it. Operational expenses, 50,000 per year. So 50,000. And each year it's going to be increasing by 103. Okay. And markers like 20, 32, 119. So I'm going to put here. I already forget. 20. 32. What else? One, 115. 015. Like this. Remaining balance. Okay. And my capex and net working capital. My capex it's 500,000. My net working capital 0 in the initial year. Okay. And I know that net working capital for each year, at the beginning of each year, it's a 10% of the revenue. Not the next one, but the current. Yeah, but it says in the question, it's just 10% of the revenue, not the expected one, the next projected sales. It doesn't say like this. So it means that 30,000 here, but I will correct this one, minus 30, minus this, minus this, minus this, minus this, minus this, and minus this, minus this, minus this, minus this. There we go. Yeah. Yeah. And depreciation is where you're going to be using this 0.2 by 500,000. I'm going to fix it. I'm doing quick because we are kind of behind of time. And ABIT, I'm going to be sending you with this. This minus this minus this minus this. Okay. And for depreciation for the last year, I'll just to show it to you, it's here, okay, we're not gonna be using it. Okay, and tax, I don't remember the tax, 25%. That's what we have it. OCF after tax. Depreciation. We're adding back. Terminal value. It's salvage value, which is we're gonna be selling it for 50,000. So salvage value is 50,000. So 50,000 plus all net working capitals. So sum of the all net working capitals minus 0.25 multiplied by, we have the book value remaining. So salvage value minus book value. Again, formula. I'm just using the formula, just getting the formula. Formula is salvage value plus net working capital minus tax of the selling price. And total operational cash flow, we're just gonna be adding these two and minus net working capital as we did it in the previous example. And in the last year, I will add terminal value. And my investment cost is this. And NPV discount rate is 10%. Yeah. Yeah. NPV is 10%. The value plus investment cost. And IRR 11%. Okay. 10%. It's here in this question. Okay, let me give you this question. Control spring, control, okay. Oh no, I don't want to come here. Anyway, you will access it from the quiz, okay? Oh, it's here. Many times I pasted. Sorry. It's already there. Oh, my bad. I will do it now. I will do it now. This is MBA. MBA and then Fin. One is the Master of Business of Administration. The other is like Master of Finance. Yeah, that's the only the name, but the course is the same. Some of you has got like maybe advanced corporate. Like I'm giving him like advanced questions. You don't see it. Like some of you were telling like why these guys having the different questions. They had even complicated question than us. Sorry? Oh, you both guys have the same. The only thing the difference making here that we have some of you already working in like big fours, like some finance companies or some financial analysis. that makes the kind of advantage. But in here, I can't do anything. Like the only thing that I can do, like let them go out and stay, and we do all. Okay, guys. I need to like. This is what? This is corporate finance. Let me check it. Let me check the corporate finance, whether it has an access or not. Come on, no internet connection. Okay, anyway, let me save this one. Okay. And turn it off.